So that's the company itself, and the company has offices in several countries. They have, let's have a look how many stores they have altogether. Altogether, they have 390 stores in North America and 278 stores international. So about 40 to 60 maybe 70 to 30, yeah, and then maybe 40 to 60, something like that. So they have 40% of international business, so which is pretty good. Okay, and let's have a look. Also, they have quite big range of products, so clothes for women, men, different collections. So they have their own brand. Michael Kors, not only unbranded products but also branded handbags, shoes, watches, different accessories, gifts, and here they have sales. So if you go to their website, you actually can buy it online, and it's a huge advantage because some companies, they're missing this point, and they're already way behind. They cannot sell a product, and Amazon is killing them, like individual traders are killing them. And those companies which started to introduce online sales, they're kind of moving forward like in the proper steps. Like, I mean, they can replace. If you remember, last month we analyzed WSM. They had 51% of their sales made online, which is fantastic. That's why WSM, we discovered like a very good, solid, strong company because they are moving in the same trend direction as other huge big retailers. Okay, and they're cutting their cost by closing stores, but at the same time they're improving their online revenue. So Michael Kors does it as well. I looked at their store. I wasn't impressed, to be honest. Okay, so it wasn't something like fancy, beautiful, and easy to follow, but still. I'm not sure, they don't give us breakdown how much sales they made online. Probably we have to go to SEC and look at this more precisely, and if you decide to invest, I definitely recommend you to do that. Okay, that's the company itself. And so if you go the value line, okay, let's have a look at them. So when the value line introduced report, it was 27th of January. It's already 2 months past. So the price now is 37.50, so it's below that. At that time, PE ratio was 9.9. So now you probably understand it's lower than that. Okay, about 10%, so it's 8 with something points. We'll have a look at this later. Okay, they don't pay any dividends. Now, even based from that price, $43, value line predicts that this company might be in a price range between 65 and 100 in 2019, 2021, so in 3 to 5 years. So which is going to give you 10 to 23% potential growth, because the share price now is already nearly 15% lower than that price. So it gives you additional growth rate here. Okay, so it's now much more than we can expect here. Now, also what, let's have a look here, debt level. Debt level is $384 million, and capitalization is 7.2 billion. So I presume it's just a bit more than 5%, around 5% in capitalization. But for us, it's more important to understand, can they cover their debt and interest? So we see that whole debt, 384 million, is in 5 years, due in 5 years. So they don't need to pay it right now, so they can pay it in 5 years. Let's have a look, what's their net profit? We can see that 2016, their projected net profit, 735 million. So the question is, can they pay their debt? Yes, they can. Yeah, so they need only about 7 months of earnings in order to pay their debt completely, fully. All right, so and have no debt whatsoever. So that's kind of a good thing for us to see. Now let's have a look at their sales, earnings, and other parameters. Now sales, let's see it. $6.7 start like 5 years, and $10, $16. Now, what's the growth rate here? Like if you can calculate it quickly enough. So here it's nearly $5 growth, like $4 growth, right? More than $4 growth on a $6 share, on like $6 on one share. So it's what, about nearly 80%, 60% growth, right? More than 70% growth here. Yeah. Then from 10 to 16, another here 50% growth at least. So when people see that, type of growth in sales and look at earnings were nearly doubling from 40 cents to 78, 100% growth. Here from 78 to 197, more than 100% growth. Here from 197 to 3.2, so it's again like about maybe what 60% growth. When people see something like that, they start paying too much money for this company, okay, because they believe it's going to happen forever. Remember, if area makes people crazy, they think, oh my goodness, if it's so good for a couple of years, it's going to last forever. And also vice versa, when something bad happens, it's going to go and continue like that forever, and they start paying very, very little. So, and that's why it's important to look at book value, price earning ratio. What can we see? That they were willing to pay 25 times their earnings when the company was growing. And when the company slowed their growth, look at this, it's become 18, then 10, and now it's 8. So if we look at profitability, like earnings in 2013, the earnings were $3.2 and the price was $84, and here it was the price is $100. Now the earnings are higher than here, but the price is 3 times less. Where is the logic? Do you see the logic? Like why people for the less income were willing to pay more than now for lower income they are paying less? The only difference here is the potential growth. Here they expected that the growth will sustain 50 to 60% every year, which is insustainable. Usually it's only, in my practice, only a few years company can last like that, and after that they stop growth, stop growth in that way. But companies still keeping their companies profitable, and that's what they can see. They expect the sales per share be $28 in 2016. They actually already reported it, and then 29. So not that huge growth, but still growth. And then they're planning in 3 to 5 years to have it $33. Now with their earnings, 444, we can see it slight move down 10 cents. Then they expect 4.6 in 2017, and then $5.50. Now the interesting thing about it here, we can see that there is a sales growth here, but if you go to the company as a whole and look at what is going on here, look at this, it's 4.7 billion, and here 4.5 billion. So why does it happen? Who knows? Who tells me why? In general, we can see that company has less sales, but sales per share, they're higher. How can it happen? Who can tell me? Correctly, Jeremy. Absolutely. Yeah, share buybacks. And that's why we can see it here. So common shares outstanding. We can see that they had 204 million shares in 2013, then 199, then 176, and 160 this year. So they bought 16 million shares from last year to 2016. So that's why your income per share, revenue per share is growing, and income is staying flat here. So it's kind of a good thing, because here we can see it's about 11, probably 12% drop in earnings here, from 840 million to 730. So it's 100 drop. So I presume it's about 13% drop in earnings. Now we can always ask why it happened. And first of all, revenue dropped. Okay, we can see, but revenue dropped only about 5%, but earnings dropped 13%. So probably they have a lower margin, and that's what we can see. The margin in 2014 was nearly 32, and now it's 25. But they believe they can increase it to 27. And then we can see a net profit margin. We can see it was 20, and here 16. Okay, but they don't see that they're going to grow. So if they show us that their profit is going to grow, it only can happen by increasing sales. Okay, because margin is going to stay about the same. Okay, slight improvement, but not significant improvement. Okay, so that's what we have to take into consideration. Okay, and all right, so here probably return on total capital is 31%, 41%, so it's quite good one. Okay, so if you look at that particular thing, that's what Warren Buffett is looking for. Now, second part, cash position and current position. So what we can see, cash 2014 was 970 million. 700 million in 2015, 186 million in 2016. So it's dropping quite a lot. So we can see that assets level moved to 700 down. So it's exactly the cash is missing here. The question is, what do they do with cash? For us, it's important. We still see that assets are higher than liabilities. Here it was nearly what 1-to-7 ratio. So it was only 330,000 in liabilities and 217, 2 billion in current assets. Here we can see 830 in liabilities. So current liabilities, they grew, okay, but assets reduced. So we can have different ratio now. It's still all right, but the question is, so what happened? Where did they put this cash? Do you have any suggestions based on what we already covered? What do you think they've done with cash? Correct, Peter. They bought shares. So they used their cash in order to buy shares. And it's actually a very good thing, because if you have $2 billion laying doing nothing, it's useless, if you don't invest. And if you believe that your company is worthwhile buying, so why not to do that? Why not to buy it? Especially when it's collapsed probably to the low prices, it's a good point to buy it. Okay, so the growth rate. So what we can see here, we can see that sales were growing 30% in average. Like some years we could see that they were growing like 70%, some of them low, but in average 30%. And earnings 58%. And then we can see their future growth is much less. So they expect that they're going to grow only 7.5% in sales and 5.5% in earnings. That's why investors were floating that stock. That's why the share price started falling down. But for us, it gives a tremendous opportunity, because despite the company doesn't have high potential in growth as business, but they already undervalued. Okay, so they still are going to grow, they're still expecting to grow, and that's what we see. They have a seasonality certain. We can see that this quarter is always higher, right? 740 here, then 1 billion, then 900, then 1 billion 50, then 1.3 billion, then 1 billion. So we always can see that this quarter is better than many other quarters. And also we can see that earnings here usually higher. So the quarter ends in December. Okay, so I presume it's Christmas shopping and etc. Okay, so that's what we can tell about this company. You can read more about here, but that's what I already told you about this company. And but what happens that Value Line assessed that this company has quite high potential for growth as well. Okay, like a jump on board as rebound potential is wide. That's what they expect. That's their conclusion about this particular company. So what do you think, guys? Is it a good quality company or not good quality company? Is it undervalued or not undervalued? What's your opinion before I show the score? And have you analyzed it yourself before you came to this masterclass? Okay, 4x4, 4x3. Some people saying, okay, growth is not enough. Shares 4x4. Okay. Okay, so online good company, but it's high to buy it right now. Good ratio, close to resistance. I think 1 day on 1 day chart. Okay, perfect. So yeah, kind of majority of you say it's still a good company. Jeremy said growth is not enough. I completely agree with you. So you would like to have higher growth in the company, but we always compare what potential growth not only in the company itself but also price perspective. So if it is a good stable company but for whatever reason it's so badly undervalued that now it makes so cheap, so you go jump and buy it because in a while it can go higher, and we're going to cover it now. So where can we expect fundamentally this company to be? Now that's the TACN score 47, so it's one of the highest. So it's above 40, so that's why we give the highest score 4. So it passes our test for quality. Now the price analysis, let's probably go through this in more details with first company. What we can see. So what we do here, like try to cover it again. So we take the maximums. That's where the company was at the maximum during those years: 27, 58, 84, 101, 75. Okay, and that's the lowest. And we can see that here 23 to 27, 25 to 50, 50 to 80. So they move sometimes they were 40%, okay, in price, and that's the earnings. So now we see that earnings during that year they are 197. They didn't change. They were, but the price was varying from 25 to 58. Here $3 earnings, but the price was moving from 50 to 84. So it means that during that period, people sometimes were willing to pay only $50 for $3 earnings, and sometimes they were willing to pay $84 for the same earnings. So what we've done here, we calculated averages, and we calculated average high, and we calculated average low, and then we calculated average earnings. And based on that, we decided to calculate, okay, what's the PE average for lowest points? So in a most depressive time when the company was priced at a low point, how much people willing to pay higher than their earnings? How many times? And that's what we do. 40 divided by 297, and we get 13.88. So that's PE, average low PE. So in average, for the last 5 years, people were like investors, traders, they were paying nearly 14 times higher companies' earnings. And let's have a look, okay, in a period of euphoria and when everything was rosy and nice and people believed in the company, how much they were willing to pay at the highest points. So what we do, we divide $69 to $2.9 in earnings, and we get 23 times, so 23.67. So it tells us that in the past, that was our statistic. Sometimes people, when they're happy and confident with company, they were paying 23 times their earnings. And when they're in depressed situation, don't believe in the company, they're paying 13 times their earnings. So based on that, we can expect that sometimes in the future it might happen the similar situation. Whatever happened in the past, we can expect happens in the future. So that's how we calculate our score. So what we take, we look at their future earnings. So if they are right and they're going to get at 5.5, so assumptions here that the value line and the company's management, they're right and they're going to go to $5.5. So, and then we multiply it by highest PE ratio, so 23. So, and we comes up with this number, $130. So based on these two assumptions, that first is the company is going to make this money, and second that sometimes in the future people are going to pay 23 times more of their earnings, same as in the past, right? So the share price might achieve at some point $130. Okay, and if the company is not going to grow, if the company is going to stay as last year, okay, flat, and we are going to pay on the lowest PE ratio, which was in the past, right? Ideal, like by idea, this company has to be $13 multiplied by last year earnings, or you can take current year earnings because they dropped a bit, right? We will see it's $61. So if we analyze this company, we can see that between 61 and 84, that's the range, buying range, based on TACM analysis. But the current price is $37, so it's much lower than $61. So it's already past this level, and it's went even lower than that. Okay, so it gives us that the risk right now is much lower than it was any like period during these 5 years, any moment during these 5 years. And so in this case, we can see that the potential of growing up is quite significant if the company will increase their sales level, because at the moment that's what is scaring people, because they believe that future earnings will be smaller, and that's why they're willing to pay now less, because before the company was growing, now they can see the drop in earnings. So that's the only questions which we have to answer: why the company has their earnings dropped, and is it possible to improve the situation or not? Okay, if you manage to answer this question, that's a gold mine. Because if you tell, no, look, I don't see that the company in any way can increase their profit, and the company has some internal issues, they have delivery issues, they have quality control, like product issues, etc., 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 and you decide, okay, so I'm not investing in this company. But if you see that the general drop in prices happened because the market as a whole like has less energy to buy stuff. Like a lot of people stop shopping and doing it less and less and less for the last few like quarters. Okay, and that's why not only this particular company dropped in price, but a lot of their peers. Okay, in this case we can say, look, it's cyclical, and in 2-3 months, 2-3 quarters, it might go back up to the favorite company position, and everyone will be investing, and that's it, the company will move up again. Okay, so that's what you need to answer before you keep going after this point. So if you're not happy with the company, don't bother even looking at technical analysis. If you're happy with the company, then you start looking at technical analysis. Okay, that's the key. So always analyze the problem which company has. And here we discovered that the company major problem is overall market weakness. Okay, is a general. Okay, so that's what happened.